Peter McQuire joining us. He's CEO at XM Australia. Very good morning to you, Peter, and great to have you on the show. Let's just start by putting things in perspective on what has happened in the US market and why recessionary fears are back with a bang because of two or a couple of data sets. This is a whole week of data that we're going to be seeing, but there's two data sets talking about factory activity, which seems to have spooked the markets. Do you think this is more than anything else?
I can't hear it.
Can you hear me, Peter? Okay, I don't think Peter can hear me. We'll try and fix that audio for you while we get a handle on that. Let's just get you through that data which was really hurt. So this is ISM data which has come in lower than what was expected, and that is what has triggered off this entire chain. Bond yields as a result have also slid off, and we'll pull up the Treasury numbers that came in. So they slid to 3.83% as economic fears grew. The crude piece is also important. Two factors there which has led to crude prices really getting dumped down. Brent was as low as 73. That's because of high output. Libya has sorted out its problem, so their output is back on the table. OPEC Plus is also increasing. So high output, but on the other hand, concerns about demand. Peter, can you hear me now?
Yes, I certainly can, Tamara. How are you?
I'm good. I'm good. A very good morning to you from where we're sitting. It's not looking like a very good morning for global markets. I want to get your sense on what we've seen in the US markets and the data points which have led to concerns of economic activity in the US. Do you think it's a bit of a knee-jerk reaction?
Well, I think a couple of things. First off, and good morning, I feel as though that PMI number that came out was very soft. And I mean, that hit the market at 47.2. So it's taken it by a bit of surprise. Hot air came out of the market. Nvidia was down nearly 9.5%. So that really, I think, as it says, spooked the market and spooked investors. NASDAQ sell-off, that really crunched it down. And, you had 5 days of strong US dollar growth, and that gave up some hot air and crude energy prices. Well, they've taken a dip lower on what you mentioned as far as Libya and overall demand moving forward and increasing production.
Peter, is it just manufacturing data, weak readings from the US, or is this more to it? We've been buying into the expectation of a Fed cut for over a year now. It's around the corner, to say the least. Do you feel like it is buy the rumor, sell the news that we are getting into? And do you feel there could be some disappointment? Because it seems like the Fed will give a 25 basis point rate cut. A 50 is what the street would look ahead of. But it's also a tough month, right? You've got US elections. Historically, September is difficult. Is this going to be an extended period of weakness, and should it be bought into, or would you just avoid markets and take chips off the table?
Well, Samina, you could answer that, and you could talk all the way up to the election and not draw a breath. Quite simply, first off, you've got NFP coming out Friday. How's that going to look? Then you've got the JOLTS report. You've got Thursday as far as tomorrow. That'll be the non-manufacturing. So all of that moving forward, PMIs. Then we've got to see how weak, if there is structural weakness building on last month as far as NFP, that's really going to concern Fed Chair Powell, because it's 2 weeks today is the 18th, and that will be decision time for the Fed with policy. Is it going to err on the side of 50, or are you going to be stuck at 25 basis points? The jury's out. I think it's a 50-50 throw of the dice at the moment. And then naturally moving up to 2 months tomorrow, and you've got the election. So, Samina, I'm not suggesting being out of the market, but it's fully priced at the moment. More importantly, I think if you're going to trade it, be very much aware of hedging positions and be conscious that these markets are volatile at the moment.
Okay. So, Peter, but simple question. There is a fall in the markets. Is this a fall that will get bought into preempting a rate cut or rate easing cycle of 100 basis points until December? Or do you think growth worries will take the markets lower? Also, just a follow-up there very quickly. Crude prices coming off too. Do they see a bottom, or is it difficult to call that?
Niraj, first off, I'll answer the other one. And good morning. Crude prices, I feel as though structural weakness, they'll bounce probably at about when they get to 67, 68. I noticed copper was off 2.5% overnight as well on the LME. So all of that, I think that you've just got that downdraft as far as energy prices. As far as, sitting out and just observing, look at the VIX, look at fear gauges. and take on board the overall global economic themes, because you've got very, very high equity markets. You've got wild gyrations across currency markets. Gold's at all-time high. That should be a wake-up call for investors. And you've got a softening energy market through demand. So, you've got to be across these markets to trade them. I don't think to get out of the market, but be very conscious as far as the big swings and roundabouts that you see on nearly a daily level.
Peter, in a situation such as this, where it's risk off, at least for the interim, gold usually does well. But what we've seen is gold has been doing well in a risk on environment. Do you buy gold at current prices for the next couple of months? Maybe not strategically, but tactically, could it be an allocation to make?
So, Mina, this time last year in October, we had a low of 1800, 1805, and you're now at 25, nearly 25.50. So it's a time to be in gold. You've had that huge uptick over an 11-month window. It's been extraordinary. And our traders, and we've got about 12 million across the world, that's primarily our biggest market that we trade. So I think that that's a retail appetite, and central bank appetite is very much focused on precious metals, gold, silver. So I don't think that's going to wane anytime soon. And I think it's a time to probably stack up on it, look at the paper market, and also look at the physical market, because there's a lot of attraction as far as currencies, what's happening with interest rate policy, and a time to, put some more under the bed.
Just last point from me on view on emerging markets and the impact over all of this. Of course, our Nifty implied open this morning shows that we're going to have a bit of a rough start. But the India story, how linked do you think is going to be to what we're seeing in the US over the next few days?
They're all, the interconnectedness, Tamana, is just, markets are connected, and sentiment drives markets, risk on, risk off. And the other side is, if you're long particular markets or getting crunched to the downside and you've got open positions, margin calls come into play, people stack into other positions. So there could be a time of recalibrating your own book. The growth story for India hasn't changed in my view, and many of the world's esteemed analysts say it's the place to be over the next decade or two. So I think there's plenty of upside for India yet. There could be just a minor hiccup, and that's traditional, what we see in all markets, Tamana.
Thank you so much, Peter. Always a pleasure to speak with you here at NDTV Profit.